Hey, good morning, everyone. Welcome to the macro snapshot for Wednesday, June the 3rd, 2026. Okay, so we're waking up to a little bit of sort of risk off, just because over in the sort of the Middle East and the Strait of Hormuz, there seems to have, there was some ballistic missiles shot at American warships, which were defended, and the Americans in return seem to have sort of retaliated on some Iranian command centers. The point is that the ceasefire is still holding in a certain sense, but really there are a lot of cracks which are beginning to sort of appear. And what we can see overnight in response to that in perceived sort of increase in escalation is that the WTI contract, you see that oil has gone up. It's now filled that sort of Sunday night gap, which is this sort of box here. And basically, it sort of looks as though it's sort of heading north again. We don't know how much. But the point is, whichever way you look at it, and we'll also have a look at Brent here. You can see Brent is also up. But the point is here, and also if you want to have a look at gasoline futures, also starting to sort of pull upwards as well. But getting back to the WTI contract, the point here is that oil is going up. That's putting upward pressure on the bond yields, and that's also potentially sort of putting downward pressure on gold and upward pressure on the US dollar. So that classic sort of matrix effect of is still sort of in play here. And just in terms of the technicals here, let's just have a look and see where potentially the oil might want to sort of hit a bit of a pause button here, so to speak. So what I'm going to do is just on this latest sort of downdraft, just look at the fib retracement level. And what we can see here is that it bounced off that fib down here at about $86, and we're now above the 38% fib. We sort of tried to get above, we got above that sort of Sunday night opening gap or downwards gap here, and we're above the 50%. So at this point, might run into a little bit of resistance, let's say between the 50 and the 61.8 fib. Really, what the bulls will need to do here in order to sort of convince everyone they want to go a little bit higher is to get over that 61.8 fib retracement at about 98.28, in my opinion. So at the moment, just taking a bit of a pause. But basically, oil is putting pressure, as I say, on the sort of bond complex, which is putting sort of upward pressure on the US dollar. Just in terms of the politics as well. Sort of Trump came out obviously and said, "Oh, we're still talking with Iran. Sort of a deal is sort of somewhere in the offing." And he also said that he could meet up with the Ayatollah, which I think we're a long, long, long way from. And I think Trump would do well to remember that, in fact, his forces did blow up to smithereens the current Ayatollah's father. So let's just not forget the sort of the personal element here. So anyway, all that to say that I think sort of a resolution is some way off. And let's just have a sort of a quick look here at just a couple of little sort of thing, just to put this all into context. If we actually look here, just at, this is from Bloomberg, if you look at the daily Hormuz Strait, the tanker crossings, the reality is that, despite all the talk, this is the situation that before the war, there were about sort of 60, 70 tankers crossing the Strait of Hormuz every day. And the graphic here tells you what's going on. This is from Bloomberg source, that essentially there are sort of a few tankers crossing, but, we're well down. And the estimates I'm reading is that if you consider that global oil consumption every day is around about 105 million barrels, it seems that the production, which has either been shut off or shut in or shut down or sort of blocked in the strait itself, we're talking, around about 8 to 12 million barrels a day. So you're talking approximately, I don't know, sort of 8, 9, 10% of global oil production has gone offline essentially. And the question is, well, is that an issue? So again, if we now look, I just got some a great sort of a charts here from J Camp Energy. Thank you to J Camp Energy, and you can actually just see here sort of a little bit what's going on if you look at the rig count. So one of the things going on is that the US is definitely starting to produce more, and if you look at the average rig count, you can see that it's starting to go up a little bit. So more active rigs are coming online. But the question is, for real production to happen, it takes sort of 6, 9, 12 months to sort of ramp up production. So we really have to be looking at the 2027 oil prices. They need to be high enough to justify sort of increased production. So we'll look at those in a second. And my point being is that in the US, it costs about $65, $70 on average to break even. So in order for that to happen, sort of the 2027 prices, not only 2026 prices, need to be at that elevated level. So before we start talking about an even greater ramp up in production in the US. We need to be keeping in mind that those 2027 prices are well above, let's say, $70 on average. Now, as we can see here, this is just the price, but let's just keep on going through. The other thing as well to keep in mind is that why hasn't the oil price completely ripped to 150 or $200 is because we're drawing down inventories at significant levels. And last night in the private ADP number, American, petroleum numbers, we got a drawdown, I think from memory, of about 6.5 million barrels. So the inventories have been drawn down very, very significantly. And this morning, we'll get the official US government, the Department of Energy, the DOE numbers at 10:30, which we'll keep an eye on those inventories. So the point is that the inventories are being brought down. And the other thing to keep in mind, this just sort of zooming out a little bit, is the real price of US crude. And people talking about $90 crude. So is that putting a pressure on the consumer? Yes. Is that putting pressure on companies and input prices? Yes. But to say, well, why haven't we gone into some kind of global recession, or why is the economic pain perhaps not even more? Just keep in mind, and again, I'm not really drawing any conclusions here. I just want to sort of draw our attention to the real price, so inflated, adjusted for inflation. And you can see where we are now, May 2026. Let's call it about $98 here per barrel. And you can see here that on an inflation adjusted sort of situation, it could be worse. Now, what do I mean by that? I'm just trying to say that $100 barrel of oil in 2026 is not the same, of $100 barrel of oil in, let's say, 2005. Because inflation is a lot higher. So therefore, the relative impact is less. So what you can see now is that, yes, it's gone up, and yes, it's causing pain, but we're still not at the painful levels we had at the start of the Ukraine-Russia conflict, or even going back to certain points, 2014, 11, 2008. So that's kind of interesting to keep that in mind. Now, if you want to put that there in a percentile level in terms of the pain level, of what percentile of sort of pain in sort of real terms, you can see here that, we're in the 65 percentile level. So, it's not at max pain here, but we're certainly not in a comfortable level in terms of the real impact of the real price of crude oil. But having said that, so if you look at production here, just from the US definitely is starting to produce more. It's producing a lot more. It's refining a lot more jet fuel. So you can see here that this is where we are at the moment, 2026. And you can see that, he's calling it the third shale mini boom. You can see that definitely production now almost up towards 14 million barrels a day. US is the world's largest crude oil producer at this point, even more than Russia and the Saudis. So, definitely sort of crude oil production is getting up. But as I say, the problem here, we'll just see if there's anything else here. But as I say, the issue here is to look at sort of some of those sort of further out contracts and just see, what's going on with them. So this is the front contract at $95. But let's actually just look here at, for example, some of the spreads. So I just want to look at the spreads here. So if we look here at, let's say, CL1 to 12, you can see the spread here that's starting to go up a little bit more. If you look at December 26 to December 27, that's the interesting one here. That's also pushing higher. So the spreads are going higher. And really, for example, I might even look at something like let's say, I don't know, we'll call it December 2027. Let's see if we can find that one. Yeah, and just see what's happening there. So you can see this is interesting. So you can see here that crude oil for December 2027, it's above $70. And keep in mind that the general break even approximately for US oil production seems to be between $60 and $70. So in order for extra production to come online to incentivize producers, this is going to have to keep sort of relatively elevated. And what you can actually see is that we're almost at the top of the price range here for the December 27 contract. So that's an encouraging sign that, maybe more production could be coming, sometime over the next 3 to 6 months if oil prices stick up here. But also it's a little concerning in the sense that what that's also saying is that the oil market is not necessarily pricing in a quick complete de-escalation, and considers that prices all along the curve, not just in the front month, but all along the oil curve, could remain a bit elevated. So that would sort of argue for the fact that maybe the oil prices are going to be elevated for a certain period of time. Okay, so let's just get into some other stuff as well. We had some some data yesterday. So again, just want to look at quickly at the JOLTS data, the job openings and labor turnover data here. And as you can see, courtesy of Olga Infinity for the data here. Thank you. But what I'm trying to say is here that the labor market, we're going to get a bit more information today, the ADP private payrolls numbers, but the labor market, the employment market in the US does continue to be reasonably sort of robust, maybe not incredibly strong, certainly not in all sectors. But you can see here that the estimate was for 6.88 million open jobs, and we actually came in at 7.6. So a pretty strong beat here, and that was good for the US dollar, bad for gold. Equities, not minding that, but also sort of US government bond yields going up as we have this stronger data. So the point of all this is to say the Fed, as we all know, has the inflation mandate and it has the full employment mandate. If the Fed is looking at numbers like this, it's becoming increasingly sort of relaxed to definitely stay on pause or perhaps even hike. And we can see, we'll look at the moment, but the chances of a December hike have gone up. So you can see here the numbers are pretty positive there. If we just look at the spread of the different industries, interesting to see a lot of people saying this number was a little bit exaggerated, but basically professional and business services was very, very strong. Everything else, except for leisure and hospitality, financial activities, which was a little negative, but everything else was in positive territory. So overall, fairly positive. If we look just at a couple of sort of ratios here, which is interesting for the general picture here, you can see the number of job openings to unemployed people is now positive over one. So that means that there's more than one job per person. And just to put that in perspective, once we got out of the COVID, that was almost like two jobs for every one person. So obviously that's come down. But the point is this is starting to point north again, which is a sort of a positive in terms of the job market metrics. If we also look at the jobs workers gap, you can see here that the gap of the amount of jobs to workers is actually going positive. So again, that's telling us some good stuff. Now, in terms of what kind of economy it is or labor market, the hiring rate, though, is still pretty low, and you could argue that's sort of going down a little bit. So the question here, we do seem to be in a situation where it's very stable. You can see that the hiring rate is low, but we have to ally that to the layoffs rate and the discharge rate, which is also pretty low as well. And if anything, going down a little bit. So it seems that people also are not quitting their jobs. You see that it's at a pretty low level. So it seems that people are basically staying put in their jobs, saying that the labor market's not so great that I'm going to quit my job voluntarily. Okay, but on the other hand, employers, they're certainly not employing a lot more new people, but on the other hand, they're not really firing people. So we seem to be just in this sort of state of equilibrium where, there's sort of a few new jobs, a few new hires, not too many layoffs. People are sort of still a little nervous and they're not quitting. So the job market just seems to be stuck in this sort of pretty stable band, which, to be honest, is probably not a bad thing for the US economy. And from the Fed's point of view, does not signal at all that they need to be sort of, yes, keeping an eye on inflation, but on the other hand, saying that, oh, the jobs market's cracking, we need to be sort of cutting interest rates to stimulate. They're definitely, that kind of data is not showing us that. And today, we'll get a little bit more information about that. And we, in terms from the ADP numbers, but also we're going to get the beige book. And keep in mind that the beige book is just the different sort of districts for the Federal Reserve. We'll get a lot of anecdotal evidence about, we'll get about the labor market, about sort of new orders, also maybe pricing pressures, sort of profit margins. So that's going to be, that's normally released at 2 p.m. So we'll get the beige book today. The ADP numbers this morning will give us a little bit more nuance on the US economy. And talking about the Fed, you can see here that with the higher oil prices leading into higher inflation expectations and the pretty strong sort of US sort of employment data, basically the market here is pricing in for December now at about for one cut, 41.6%. If we actually look at the aggregated probabilities, which is all of the different sort of pricing put together, you could see here that the chances of staying on hold at this point are just 23%, zero chance of a cut this year. And you can see that if you look at the aggregated numbers, more or less for sort of a hike, one or more hikes, you were up to about 77%. So, getting up towards, 18, 19 basis points at this point. So as I say, that could even get up to sort of 100%, a full sort of hike priced in for the end of the year if the data continues to be strong this year. Okay, so let's just get back to a few other markets and see what's going on. And again, it's the same old issue here that with where are we? Sorry, I need to go to my charts. So just having a quick look around at markets, you can see the VIX here still pretty low. There's still a huge amount of sort of interest in sort of call options. The skew is very much favoring sort of call options at this point, or much more so historically anyway. So, but the VIX remains, it was a little sort of bumpy a couple of times yesterday, but essentially remains at a relatively constructive level. And remember that if we have low volatility, a lot of the volatility sort of focused funds, they will just slowly sort of add to their position and from an index point of view. And that's why we're seeing the index grind a little bit higher. Obviously, there are individual stories which are doing incredibly well. But basically, as long as the index volatility remains relatively complacent, then, the index sort of buyers can sort of grind higher. On the other hand, if we look at the bond market sort of volatility, that's going a little bit higher. So that could start to put a little bit of pressure. And if we look at the bonds, let's just have a look here. Obviously, as we saw the energy prices going up, if we just look at the yields here, I just want to look at, let's say, the 2-year yield. You can see that that's going north by a few basis points. We're starting to push higher. And the all-important 10-year benchmark, we're not quite at 4.5% yet, but we're at 4.481. So just a basis point or two away from the 4.5%. Will that provide some overhead resistance? It's going to really depend today on the price of oil. It's going to depend also like the ADP data to a lesser extent. We also have ISM services today. Remember that the ISM manufacturing on Monday was quite strong. So the services makes up about 75% of the US economy. So that's going to be important to see. Again, are the sort of price inputs are going to be sort of high today. That's what the market wants to be looking at, and that's going to affect the bond yields. On the other hand, we also, of course, want to be looking at employment numbers and new orders and the headlines. So they're the four components of the ISM services at 10 o'clock we get. Let's keep an eye on those. And so, let's just see if they're very, very strong. We could see the 10-year yield pushing that 4.5% level. Also, the 30-year yield here, not quite at 5%, but that's going to be a key line in the sand as well. So the point is the bond yields are going up. That's supporting the US dollar, not in a massive way, but still, starting to trade towards the top part of this range. And I think that, as long as if oil continues to go up, if bond yields continue to go up, and therefore the differentials with other countries' bond yields continues to blow out a little bit, that's going to be putting upward pressure on the US dollar. And I think it could trade to that, sort of fill that gap here completely and trade to the top of its range at about 99.5, which of course is going to keep the euro sort of subdued, even though we have the ECB probably hiking on the 11th of June. So basically about 8 days from today. But that's fully priced in, the 25 basis point hike. We also have a second hike by the ECB fully priced in for the 10th of September. So 2 hikes are sort of fully priced in by the market at this point. And that's why the euro is finding it difficult. Well, it won't sort of completely collapse, but on the other hand, as I say, those ECB hikes are priced in. So the euro probably just trading in this range, maybe towards the lower part of the range, if factors line up for the more hawkish Fed and for a strong US sort of data and higher US yields. Other currencies, you can see here the New Zealand dollar, I sort of signal that's getting to the top of that sort of double top or triple top range there. That's come off quite a lot, but this is going to be interesting here for the bulls because now we've retraced 61.8%. So if the bulls do quite like the idea of a relatively hawkish Reserve Bank of New Zealand, this is the moment for the bulls, maybe sort of buy the dip opportunity here at about, what is that, 58, this level here, 58.60-ish, something like that. That's going to be interesting. Keep an eye on the New Zealand dollar. That's a nice level there. USD JPY continues to be strong. Probably still too early for intervention talk. I think we at least want to get above that 161 level, sort of more around this range here. But for sure, Japanese inflation is Ueda overnight was saying that there could be a hike coming, but that's more or less priced in by the market. And inflation is not really ripping. And on the US side, things are still strong. So I do expect that could continue to grind a little bit higher. What's also interesting is something like the Swiss franc, which is under a little bit of pressure, not massively under pressure, but it does seem as though the US dollar is still pretty strong here. And that's also part of the story, like this whole sort of dollar debasement trade sort of theme, which was a bit of a theme 12 months ago. That seems to have gone away. And we see that in things like the crypto as well. So if we look at BTC, very disappointing price action for the the crypto crowd. I can see it's well now above this sort of like what seems to have been a sort of a bear flag. It's broken down below this upwards channel, below all the fib levels. But of course, this is a pretty good support level here at around about 65, 66,000. And we're getting a bit of reactive bounce. Really, at this point, the bulls, they need to support this with a certain degree of strength. Because if they cannot maintain this for sure, it looks as though we might go down, test this trend, sort of longer term trend line, upward trend line, and the recent lows at 60,000. But having said that, this does represent sort of the end of a bit of a measured move here. So well below the measured move. So it also there's no reason why we can't have a nice sort of a technical bounce here for sure. But I was just getting back to this whole sort of this whole dollar debasement trade. Everyone was saying that, oh my God, Trump's going to debase the dollar and the dollar's going to be taken over by the Chinese renminbi and sort of gold as well. And I think the gold thing is still a bit of a story, but you can see here the BTC and then the Swiss franc is showing a little bit of weakness, relative weakness. The Swiss franc, the BTC is certainly very, very weak. And the dollar is still, still doing pretty well. Having said that, a strong US dollar and higher yields is not great for gold. Gold is finding it difficult to break out of this sort of overhead, sort of downtrend resistance, still just hovering here around these sort of fib levels, essentially in a sideways consolidation until and unless we get weaker US data, lower yields, lower energy prices, and a lower US dollar. Gold is going to find it to have a sort of a sustained breakout. Similar kind of situation here for silver. Let's look at the spot price here. As you can see, sideways consolidation. Interesting with the high grade copper, the US copper here, as I was thinking, this triple top here, taking a bit of a breather. But again, what I'm going to signal here, depending where you want to draw the fib, there's a pretty nice pullback level at around about 66.5 essentially. So, and just look at how the high grade US based sort of contract has performed compared to the London contract. So this is the LME. The LME is still doing pretty well, but it's not performing as well as the US contract. And that's just because, as I've been mentioning, apart from the fact that there's a lot of sulfur which is needed for various processes in copper, a lot of sulfur is not able to come out of the Strait of Hormuz. So less, sulfuric acid. So less sulfuric acid coming out of the Strait of Hormuz means less ability to refine some of the copper processes. That's putting a bit of upward pressure on copper price. But really the big story here is that you saw that there's this big run up in 2025 that the US may impose tariffs on copper imports. That can was kicked down the road. Basically, Trump and the administration here on this exact day, you see here at the end of January, said, oh, actually, we're still thinking about that. So the whole reason for getting sort of rushing sort of copper supplies into the US collapsed. You see the price collapsed here, like literally in that day. Look at that very, very nasty pullback. But subsequently, that review of the potential tariffs on imported copper into the US, that is up for review at the June 30th, the end of this month. So the market again has been busily sort of pumping, well, not pumping, importing physical copper into the US. And that's good. So that's going to be very, very interesting. You see that US copper is outperforming London copper and Shanghai copper. And it's just going to be interesting to see if the trade representatives don't recommend a sort of an immediate imposition of tariffs. I expect copper to have a big 1 day plunge, or 1 or 2 or 3, 4 day plunge if that doesn't happen. And I think the Trump administration might actually just keep that relatively sort of ambiguous to say, oh, we're still sort of thinking about it, because ultimately that does keep copper supplies and inventories high within the US. Anyway, let's keep an eye on all of that. Apart from that, guys, as I say, just finally finishing on the equities here. Equities grinding higher, at least at the index level. We have Broadcom earnings today. They're expected to be pretty good and keep this whole sort of AI chips, semiconductor story and thing. But you can see not really ripping higher, but just sort of grinding higher. As I say, in this low volatility environment, ES doing pretty well here, new highs. Nasdaq doing well. The Russell small caps. The reality is at the high. So again, there's just this whole sort of argument of, there is just like an earnings sort of revision sort of story. and the semiconductors and the tech story and capital expenditures and earnings going high and multiples going higher and profit margins going higher. We have all of that stuff. But on the other hand, the problem is where we could get under pressure is that it's also turning into a little bit of a sort of a capital absorption kind of cycle story. So there's a lot of capital being absorbed here. And obviously we know about all of the IPOs for SpaceX is going to absorb a lot of capital. We have OpenAI, Anthropic. We just saw Alphabet with $80 billion of extra sort of equity being issued to raise some money. And there's a lot of financing necessary for the data centers, for chips, for infrastructure, for power, for networking build-outs. All of this stuff is a capital absorption cycle kind of story. And that at a certain point is going to be in tension with the sort of earnings revision sort of a story. Now, if you add on to that, the extra sort of cost pressures of sort of the energy complex and oil, that's adding an inflation premium. So all that to say, and of course, there was an announcement that tariffs, the whole thing of tariffs is still bubbling away. So the point is that you have potentially with the tariffs, goods inflation, you have energy inflation, and just in terms of the bond yields, you have this whole thing of sort of governments issuing a lot of debt, inflationary pressures, and of course, this whole capital, this monstrous demand for capital coming from the whole AI sort of complex. And the point is that, let's just keep an eye. There's definitely two sides to this story. And at the moment, the sort of AI sort of earnings revision story is the one which is dominating. And you can see that, let's say you look at the Mag 7s, coming down a little bit, but still pretty strong. But obviously the semiconductors still ripping higher. You can see memory, DRAM ripping higher, the software ripping higher, come off a little bit, but basically overall the tech sector doing incredibly well, not just in the US, but also you can see that in you see in Japan, you can see it's ripping high. You can see the Kospi remains very, very, very strong, and also in the Taiwanese sort of sector. So in the tech sector globally doing incredibly well. We know that the rest of the market is not doing as well. So really just we have to keep an eye on this sort of tension. And that's why today I'll be keeping an eye really on the front end of the yields, because as always, the oil and the front end of the yields in the US dollar, if they all remain elevated, so oil, US dollar, and the front end, especially of the yields, that's basically saying that there's still inflation premium. And as those yields remain higher and higher in this very capital intensive environment, that's just going to, eventually cause a little bit of pressure for the stock market. Not today, probably not this week, because we're still just grinding higher and volatility is still quite low. But definitely, I think the tensions are going higher. Okay, guys, enough for me for today. I'll be back. Actually, I'm going to have an open call. So anyone watching this, I'm going to do the open call at 3 p.m. That's going to be open for anyone just to ask questions, to look at any trades, any markets, any technicals, any fundamentals, anything at all about the markets. Very happy for about an hour this afternoon, 3 p.m. Eastern, just to open up the floor, so to speak, to have a bit of interaction and hear some questions. Thanks very much, guys. I'll see you at the open call at 3 p.m. Otherwise, we'll be back with the macro snapshot from the macro shop tomorrow morning. Thanks very much. Goodbye.